Hi, this is Joseph. In this video, I want to review a very particular trade setup that I've been using for many years. This is the pound dollar. This is the 30-minute time frame. So you may have seen on my YouTube channel or on my website a strategy that I use called the London breakout. That's just what I call it. Other people have different methods. Some of them are very similar to mine, and this isn't a new method at all. I mean, this is a strategy that a lot of people have been using. It's very generic, it's very basic, and like a lot of different trading strategies, it's really important that you understand the mechanics behind the setup and then work on trying to improve that setup if you like it. If there's, a lot of times people will try a different technique for the day, and then for whatever reason they don't like it. Maybe they don't like the indicators, they don't like what's going on, or they just don't understand it, and they move on to another one. But there are some very basic reasons and principles at work when you see turning points in the market. So you're looking at a couple of them right there. You can see the one that reads BC up there at the top left, and you see another one that reads AR down there at the right on the left. And again, those are specific turning points relative to this time frame. So I'm not going to get into the mechanics and the details as to how to identify these turning points, but I am going to share with you a strategy that will help you pinpoint it. I'm trying to not get into too much detail is the structure. Who is it that steps in at these times when price starts moving like this to the downside, or price starts moving up, in an uptrend or a downtrend or a rally for the day, or maybe a couple of weeks, or even on a different time frame. It's really important that you understand classical technical analysis so that you can read that footprint. There's usually volume involved, and I use point and figure charts. So these are all classical technical analysis skills that I've used for many years, and I use them every single day. I'm always working to improve my ability to use them. So again, outside of identifying this downtrend, we're just going to look at it technically. Again, I'm not going to break down the structure like Wyckoffean logic or price structure behind this kind of movement. We can talk about that in another video. That would go on and on for another 30-40 minutes, and I'll do that. I will do a presentation where I talk about how I use Wyckoff price structure to identify these turning points, but I want to show you again how you can use this in a real basic method, a very basic strategy. So again, London breakout strategy, I'm using it the same way that I started using that strategy with trading breakouts when I started trading futures. So I started trading back in 2001, and I started trading the S&P, and I would wait for, sometimes I would switch to a 5-minute bar, but usually I was trading off of the first 30-minute bar. So I would use a bar chart, and I would watch the market open on the S&P, and then I would wait for price to take out the high or the low of that first 30-minute bar at the open. Well, when I started trading Forex, I started doing the same thing. I started watching the pound dollar, and I would switch to a 30-minute time frame, and then I would watch the London Open on the pound dollar MetaTrader platform, and I would wait for the break of the first 30-minute bar. So what you see right here is a candlestick chart. You can use it with a bar chart or a candlestick chart. Either way is good. But you just want to be able to use, for example, the 30-minute chart. Now, you can test this on a 5-minute, 15-minute. There's, like I said, there's a lot of different people out there that will teach a London breakout strategy, and it's not exactly the same with everyone. Everybody has their own little twist to it, and that's okay. That's what trading's all about. Everybody kind of either tries to improve it or tries to tweak it and make it their own. That's what trading is. If it works, it works. If you like it, you work on improving your ability to read it, and you also want to know when you should avoid taking certain signals. That's another side of trading that's really difficult for people to understand, is that I'm going to show you a few trades that worked here. Obviously, sometimes it's not going to work. And what you want to do is develop the sensitivity and the ability to detect when the trade is not going to work and what's wrong with the price structure. So that's why I'm talking about price structure, the turning points, because I will only execute this London breakout strategy at specific levels. So this white candle right here with the arrow, that is the first 30-minute bar at the London Open. The first 30-minute bar. So again, 30-minute chart, 30-minute candle, 30-minute bar chart, whatever it is that you like to use, and I wait for price to take out the high or the low by 1 pip, and then I get into the trade. Now, when price started to rally at the open for the first 30 minutes, I realized, and we get this a lot, you see this quite a bit, where you see some kind of a move at the open or prior to the open, and then you get that reversal. I think most people are pretty familiar with the fact that markets tend to do that at certain times of the day. Very often, if you watch the first 30-minute bar, the first hour of trading at the beginning of a specific session, you might see some reversals like this. So again, it's important to understand the structure. Again, I'll talk about that in another video. This is actually a buying climax here, and this is the automatic rally or the reaction that is created after a top is in place. And it doesn't necessarily mean that I have to wait until price sits down here at the lows or up here at the highs. You know, you might be able to get another entry opportunity to short it. One of the things that I would do is use my point and figure to get an opportunity to short it if I didn't get in, you know, at where I'm supposed to. But with the London breakout strategy, you'll notice with the 30-minute bar, that's the first 30-minute bar, and you can see that's a pretty strong, you know, it covered quite a distance there. The spread from the high to the low is quite big. Now, this is the following day. This is the first 30-minute at the London Open, and you can see that this candle is about half the size of the previous day's candle. But notice where it took place. Notice that just before the market, the London Open, here on that red candle, there was some kind of an uptrend. It was moving right back up into that area of resistance. So at that point, I start to pay attention, right? We see retests of resistance and support, and very often they're much better opportunities to identify the footprint or the signature, the volume. I'm going to show you volume here in just a moment, and to identify this key reversal. That would give me much more confirmation than trying to trade, let's say, the first 30-minute bar at the opening of the London session if it was inside a consolidation like this, where support was down here and resistance was all the way up there. It's not really testing either level. It's very choppy. It's been moving sideways. Let's say that, you know, this candle right here, well, that's a pretty small-bodied candle. You can see the spread from the high to the low really isn't that much, and I really wouldn't expect much. I would much rather trade on a retest of resistance or support than trying to trade in the middle of a consolidation range. That gets pretty choppy. Now, some people have strategies for doing it. I don't trade that way. I would much rather wait for a safer, much more confirmed opportunity, just like you see here. So again, going back to this initial setup here, this was on the 24th of November. So we had a run up, a move here, strong move. Again, notice the spread, notice the size of the candle from the high to the low. That's a big candle. And we would expect that sometimes with the first hour or the first 30-minute of the you know, the London session or even the New York session, for example. But again, it's sort of stalled right here, and you can see with the volume indicator, I'm going to show you that in just a moment, that it probably wasn't going to go too much higher. And you can see with the following candle here, there's a little bit of divergence in there, and that's what I'm looking for. And then, so there's a couple of different ways to look at it. If you were to switch to a smaller time frame, you might get a better entry up here. But again, I'm looking at the 30-minute and waiting for a break of the 30-minute. I just want to show you how this works with this particular strategy, the 30-minute bar or the 30-minute candle. Waiting for price to come back down and take out the low at 1.3336. The low was actually 37 of that first 30-minute candle at the London Open. I wait for price to take out the low by 1 pip or the high. Again, I didn't go long. I wasn't tempted because I could see that this was likely to be some kind of a turning point right here. Again, I'm going to show you my volume charts in just a moment and show you why I thought that. There's also another level of resistance right up here that we're going to talk about in just a moment. So if we were to look at the candle that actually put me into the trade as price continues to slide back down, there it is at 36. So when I take this trade on the pound dollar, I'm using a 20 pip stop and a 20 pip target, approximately. Now sometimes the retracement might be a little bit deeper than 20 pips. I have to be paying attention to that. Technically, I guess we could say the stop could be above the actual high of that signal candle. That would be one location, but that's quite a distance. And they're not usually strong candles like this. It's not going to look like a 50 or 60 or 70 pip candle where you would have to use an incredibly large stop. It's not always going to happen. So that's another area where you could try to work on improving. If you are going to use a small stop loss and you see a strong bodied candle like this, well, then the retracements could potentially be pretty significant and be much, the retracement itself could be much deeper against your position, deeper than the 20 pip stop loss that you'd be willing to use. So you have to keep that in mind. If you see a strong candle like this, expect, you know, some choppy behavior and maybe some deeper pullbacks. So you would have to keep that in mind. If you're going to stick to that 20 pip stop loss and you want to trade something like this and you know that there's the possibility of a retracement that's going to go beyond the 20 pips, don't take the trade. So that's one of the areas where you need to work on improving your skill and your ability to read this. understand all of these little nuances. So if we look at this one, this was a much better opportunity. You can see with that move to the upside on the 24th, there was already a little trending movement for a few hours. It wasn't strong, but it was during the Asian session, just before the London market opened, and maybe less participation, but it was still moving. This was a totally different scenario right here, and this was a much better opportunity. So we would expect price to move lower a lot faster in most cases. And you can see the difference and how it moved and how long it took for it to actually hit its targets. So let's go back to the targets again. From the point of entry, I'm going to be using a 20 pip target. That's my first target. So if I get in at 36, my first target is going to be 16. Now, I do not take into consideration the spread. I get that question quite a bit. Do you factor in the spread? Well, the real basic understanding here is that we're all looking for a better deal when we work with our brokers on the spread. Some brokers, it's kind of, I've seen people say this quite a bit. They would much rather use a regulated broker and pay maybe an extra pip or two on the spread, as opposed to an unregulated broker and run the risk of not getting your money out when you want, maybe the profits, or maybe you're worried about withdrawing your money. I see people all the time asking other people, have you ever had problems with this company? Or so that's something to consider. And very often with those unregulated brokers, they have pretty small, very, very tight, and in some cases fixed spreads. So it's something that you need to balance and something you need to figure out yourself what you're comfortable with. For example, I do have an account with Forex.com, and they have slightly larger spreads on the pound dollar. But again, it is regulated as opposed to some offshore company that not too many people have heard about, with really, really small, maybe half a point or 0.8 of a point spread, something to that effect. So keep that in mind, that what I'm using for the targets are just the price figures that I can see on the chart. It's the best way to keep the consistency throughout the trade. So again, if I'm getting in, I want to know where the low of that signal candle is, the first 30-minute bar. It was at 37, so my entry's at 36. I take profits at the first 20 pip target. That would be 16. At that point, if you're just trading one lot, you're done. It's a 20-point trade. That's it. You're done, you're in, you're out, and it's over with. You start looking for the next opportunity. Now, in some cases, I will, in my own personal account, scale out of the trade. And you can squeeze more money out of the trade, but you have to take this into consideration. You have to have the ability to close half of your position at the first target, and then set the second half of the trade at a break-even stop. So you protect the profits on the first target, and if it continues, this retracement went up as high as 36. So it could have came really, really close to stopping you at a break-even. But again, in some cases, when I see price moving up like this and retesting, I'm willing to give up a pip, maybe a pip and a half of the initial first target to see if it holds. Because very often we see retests like this that go just about to the entry point, and then they resume and they come back down, and you can pick up another 20 pips. So you'll notice that the second target was from 16 to 96. That's an additional 20 pips, and that's it. Now, I don't recommend getting in with one lot and then holding for the final second target of 40 pips from the entry to the final target. I don't recommend doing that, because sometimes it'll only move 20 pips, maybe a little bit lower, and then it won't hit the second target, and then it reverses and goes back up. So then you would you would have a winning trade, and you would allow it to turn into a losing trade because you didn't lock in profits where you should. Again, if you're using one lot, trade it to the first target, and then you're done. And ignore it. Don't sit and watch. I mean, it's probably a good exercise to watch it run into the second target so that you can confirm the fact that it's working. But I still would not hold one lot to the second target for 40 pips, because it doesn't always work that way. But it very often will hit that 20 pip target for sure. There's a higher probability that it's going to hit the first target for sure, as opposed to the second target. And you can see how it worked again the following day. So keep that in mind. Now, with the trade copier, I can only execute one lot at a time, one trade at a time, and close out at the first target. So sometimes I'm going to sit and watch, and I'll squeeze out a little bit more of the trade. Sometimes I can, sometimes I can't. Sometimes if I can see that it's in a strong move, there's a lot of volume, a lot of participation, maybe it's economic data at that time, then perhaps I can let it go, and very often it'll run to the second target. So then it would be one lot, one trade straight to that second target. But that doesn't happen very often, and you can't count on that to happen every single time. You just have to look at the structure. It moves the way it does like this for a very specific reason, and it's only going to go so far on certain days. So again, that's basically the setup. You just wait for the first 30-minute bar at the London Open, wait for a candle to close, to take out the high or the low by 1 pip. In this case, again, you've got to have the ability to read what's going on right here. Otherwise, you're going to get tricked or baited into going long, and then it reverses, because this happens quite a bit, and you have to know how to read it. I stay away from these because I'm using a chart that looks like this. So here's that basic idea right here. So let me go ahead and open this up, and I'll bring you right to that particular candle that we were just talking about. So I was talking about this reversal. Where did it go? I'm sorry about that. Let me bring it right back here. Here it is. I'm going to open it up again, another click. So what you're looking at is, this is actually pound futures. This is pound futures. So this is that other, this is a second level of resistance right up here. Let me show you what it looks like on MetaTrader. There it is right there. That's that second level of resistance right up there. And we were trading inside of this range, and here's what it looks like here on my futures chart. So here's that the 30-minute bar at the open. This candle where I'm moving my cursor right here, you can see the volume moving right into that move right at the London Open. It's this candle right here. That's what created that buying climax. All right, so let's go back over here. At this point, that sort of sets in that resistance level. But notice where these other bars, the additional bars, and how they close. There was an attempt to move higher, but it stalled and closed right back below. And you can see how weak the volume was on that candle. There really wasn't anything going on. So that's one of the things that I was looking at and reading. This is true futures volume. This is pound futures. This is not the pound dollar, but it moves the same way. It shows the same patterns. It gives me the same highs and lows, and I can use volume with this chart. So again, I'm watching volume. So it's sort of like this. We refer to it as the amount of effort that goes into a move, whether it's up or down, and then when it's over with, when that candle, relative to the time frame that you're using, when that candle closes, you're looking at the amount of volume that's in that trade, how much participation was in that trade, and then you look at the candle and you look at it and say, well, in relation to support or resistance, was it a strong close above resistance, and does it look like the trend's going to continue higher, or did it attempt to go above resistance but then failed and then sold off, which is exactly what we saw here on that second candle. It started to go through resistance, and then it failed, right? The whole thing collapsed, and you can see there was a stronger volume histogram bar on that candle, and it closes below resistance. There's the turning point that I'm looking for. Now again, I waited until price actually took out the low of the first 30-minute bar, which is what I'm supposed to do according to the rules, right? Let's go back to the actual trade. So there's that first 30-minute bar, and I waited for price to take out the low of that signal candle. That's the way to do it. Now again, the other way to do it would be to maybe switch to a smaller time frame and to identify everything that's going on here, that the amount of effort versus the reward or the result that you actually see in that move. Again, a strong move to the upside, but then it fails. It doesn't go anywhere. None of these candles close above that resistance point, and then you can see it starts to sell off, and then volume levels to the downside start to accelerate. They start to pick up, and that would give you sort of that divergence and that turning point right here. And it doesn't necessarily have to hit the overall resistance point to turn around. Sometimes this is all you get. This is all you get. And this was another reason why I waited for price to take out the low of that bar, because again, it didn't hit resistance. It created its own new level of resistance, and it was safer for me to wait for it to take out that low. It took a few hours before it actually took out that low. It doesn't always do that. Sometimes it'll take 6 or 7, 8 hours before it actually breaks out of the first 30-minute or 1-hour bar. Other times it'll break out in the first 30 minutes after the first 30 minutes, so within the first hour, and you get a trade then. Every day is going to be a little bit different. And if you can track volume, if you can watch volume, I'm actually using the Thinkorswim platform. So here's a tip. Yeah, I would recommend downloading the Thinkorswim platform, the demo. And this is exactly what you're going to look for. You're going to set up your charts to track the pound futures, not spot. You can trade pound dollar off of the Thinkorswim platform, but I'm looking at pound futures. Again, it's going to give me the same patterns and the same thing that I'm looking at on the pound dollar, but I want volume. I want to see true volume, not tick volume. That's why I use this particular platform. So I also trade futures off of this platform. So again, that's something that you can actually set up today. Again, a free demo version, and you'll be able to see the charts just like this. So again, there's different nuances to this technique. And I mentioned in the beginning that it's really important that if you like a strategy, learn as much as you can about it. Don't just watch one video and then try it out and then have it work that day. You know, you might be thinking, wow, that was really easy. Because the next time it's not going to be easy. The market's always shifting. The same strategies that I use that work really well, let's say in a trending environment, when it starts to get choppy, I start to cut back on my trades. It gets really difficult sometimes in certain conditions to read the markets. And anybody who says that they can see everything at all times is probably not telling the truth. It is very, very difficult. It requires a lot of focus to make sure that you're not tricked into getting into a trade when things start to go sideways and it gets a bit choppy. So again, you've got to know as much as you possibly can about that particular strategy, and then start creating filters so that you can identify when the trades are likely to not work and when the trades look like they're going to work perfectly. But one of the things I highly recommend, and I'm always looking at volume, it's a very critical component of my trading system. True volume. Again, not tick volume. Tick volume is very different. And volume itself, if you're just looking at volume, you really need to study how to read volume as well. Because very often, for example, when you see, let's say you see an uptrend, and there's not really a good example of it here, but very often people will assume that aren't too familiar with volume. They think that in order to continue some kind of an uptrend, there's got to be more continuous volume with these volume histogram bars continually larger than the previous one in order to sustain that uptrend, and that's just not the case. Very often it could be a sharp reversal and a turnaround, and you'll get one candle, maybe two candles that have a lot of volume behind it, and then that volume will sort of taper off, and it'll still continue to float right consecutively higher on each candle, or every other candle or so. So be aware of that. You want to study volume, and you want to understand these nuances with how to read the volume indicator. It's very important because it can be a bit tricky in certain conditions. So let's go back to this example. This one worked for a total of 40 pips or 20 pips. Again, if you're just trading one lot, perfect. Again, the same thing happened again the day after. Entry here at 56. First target was 36. Second target was 16. Should have moved that right down there to the, there you go, 16. So we'll take a look at that one. That one is right here. Right there. So let's move this down. And you can, sorry about that. So again, there's that area of resistance from the day before. It held. None of the candles closed above it, or the bars. And then we had, again, another move just prior to the London Open, right here, moving up. It's a very, very typical, common pattern. At that point, I'm well aware of what the previous day's high was, right in at this level of resistance, and I'm watching. So I see price at one point, pretty strong volume candle. It starts to move up. Very, very poor close. Closes below resistance. That doesn't mean it's over. I've got to wait, more confirmation. And then on the London Open, the first 30-minute bar, that's it right there, that red bar. It starts to go higher. Let me give you a quick story about what used to happen to me when I would see price taking out highs and lows. So in 2001, when I first started trading, I joined a chat room. And there were some guys that were running this chat room, and they had like maybe 8 or 9 months experience. And it was horrible. Whenever price would take out a high like this, they would tell everybody in the chat room to buy. They would just use their microphone, and very often they would just kind of yell, "I'm buying," or "Buy euro dollar right now," "Buy pound dollar right now." And I would get into a trade like this at their recommendation, and then within maybe 30 minutes, 45 minutes, it would turn around and go back down inside a consolidation, and I'd get stopped out. And I remember I was always thinking, why is that happening? Why does it fail? Why isn't this working? Why are these guys telling everybody to buy? And there was another guy in the chat room that had asked that question several times, and he kept saying, why are these failing? And they would ignore him. One night, the guy got kind of smart, the guy that was running the chat room, and he said, that's what happens in trading. If you can't accept the losses, maybe you should consider selling vacuums. That's what he actually said. So, there's guys out there that just don't have the experience to be calling out trades or telling people how to trade. They have a very limited amount of experience, and you got to be careful. I really highly recommend finding somebody, if you're going to follow them, they should have at least 10 years, maybe 10, 20, or even 30 years experience. I have 20 years experience, and I don't plan on ever, stopping, the opportunities that I find at any given moment to learn more about the markets. There's always something to learn. Like every hour I could pick up something and learn something else. Even if it's not something that I'm going to use, it's still going to give me some more insight as to why and how price moves, as long as I'm listening to the right people. I'm not going to go to Instagram and watch some guy who's 21 or 23. Not to say that those people can't trade. I'm not saying that, but you can tell they've only got a few months experience, and it's confusing with all the Lamborghinis and all the gold chains and all the the shopping that they tend to do, and they're living in this apartment, in Miami or something, and or a condo up in a high-rise building. There's nothing wrong with that, but I highly suspect, where they're actually getting their money from. Maybe they have like an e-commerce store or something else like that, and they're trying to sell their Forex stuff and their material. But be careful, be really careful. And I'll tell you, I thought I was following the right guys in this chat room, and this used to happen to me all the time. So again, as price is moving into this level of resistance, I'm clearly waiting. I need confirmation. I can't just jump in because price is taking out the high. Some people still do that. I don't. I wait. And then you see the reversal. Strong close to the downside. Strong volume histogram bar here to the downside indicates that it's likely to go a lot lower. And in this case, when it opened up, it retested a little bit and then took out the low. And you can see the trade right here. It retested a little bit and then took out the low, and then it moved pretty quick. All within the same 30-minute bar. It hit the first candle. So remember how we were talking about it earlier. These setups are going to look a little bit different based on the price structure. Here was the first initial buying climax the day before, and it stopped. And then I pay attention to the size of that candle. That's a pretty big spread from the low to the high. That would indicate something. Something's going on. That's strong. And if it can't go any further, and then I see some kind of a reversal, and I see divergence in the volume indicator, then it's likely to be exactly that. Just a move right up into the London Open, or the first 30 minutes at the London Open, and then the reversal. And the same thing took place here. It was just running right into resistance, but this time it was solidified. And you can see, as I mentioned before, sometimes the reaction is going to be a lot quicker, where it's going to move to the target a lot faster, as opposed to the way it just kind of slid all the way down here and took about 2-3 hours before it even gave me an entry. This is very, very different, and it's a very different setup altogether. You can see that because, again, the retest here. So this one hit, again, both targets. But, again, I'm going to stress this idea and this understanding that if you get into the trade with just one lot, don't hold for the 40 pip target. It might work sometimes, but it's not going to work all the time. And a decent percentage of times it's not going to hit the 40 pip target. So I would recommend scaling out of the trade, or if you've got one lot, just trade it to the first 20 pips. It's safe, it's clean, and if you know how to read the markets, again, I'm not taking every breakout trade, London breakout trade at the first or every day at the open at the London when it breaks the first 30-minute bar. Sorry about that. I'm trying to read a message that I'll get to your question in just a moment. So the question here was, can you cut the lots in half? I'll go ahead and read it. Can you cut the lots in half? And I have mentioned this. Can you cut the lots in half and then trade it? And put 2 orders in? Yes, absolutely. That would be the other thing that I would recommend. If you normally trade, let's say, a mini lot, you can cut that mini lot in half if you know you're going to be executing the London breakout strategy and you know that there's the possibility of 2 targets. So you would execute 2 orders right at the open. That's pretty simple to do. Use the same stop and then scale out. So you would lock in the profits on the first lot at the first target, and then set it at a break-even stop. And you'll notice here it kind of went right back up there to that 36. It stopped right at a high of 55, and that was 56 was the entry. So this was just about a pip away. So again, sometimes, as I mentioned, I would be willing to give up 1 pip profit from the first target to see if it's going to do exactly what it did here. It's just going to go back up and retest the level that it broke out of, which is the first 30-minute bar. A lot of people use this strategy. So very often you're going to see retests of that level. So just be prepared for that. Anyway, if you're, again, cutting your lot size in half so that you can take this trade and scale out to 2 different levels, it would just be the 40 pip final target from the entry. So it's an additional 20 pips from the first target. But effectively, it's 40 pips from the entry to the final target there. That would be one way that you could actually maximize this trade. And keep in mind, it's not always going to hit that 40 pip target. It will usually hit the first 20 pip target. And again, that's why we protect ourselves and set it at a break-even stop if you've got the other half. So again, incorporate all of this with what you see here and start learning how to read volume. It's really important to learn how to read volume and use it correctly. It will help you find these turning points. And again, I stay away from trades if the London, the first 30-minute bar set up at the London Open for the breakout trade in a range that looked like this where I'm moving my cursor. I wouldn't trade it. I'd stay away from it. It might work, but I don't ever want to sit back and look at a trade and think, well, it might work and it might not. So this is actually one of the strategies that I use. I use this with the trade copier. It works really well. Again, you're not going to get a breakout trade every day. There are times when you really have to learn to just stay away from it because it's likely to be choppy. I've seen some breakout trades, actually the signals itself. So let's say, for example, if this was a London breakout trade, the first 30-minute bar, and sometimes it'll move to the downside and it'll be a head fake and it won't hit the first 20 pip target, and then it'll move back up and it'll go the opposite direction and it still won't hit the 20 pip target to the upside, and then it just starts to go sideways until the New York session. And you can get stopped out in both directions. And you have to be able to clearly identify that that's not a turning point, if it in fact was. In this case, it was a turning point, but you get my point. There are certain days when it's going to be choppy and it's going to give you a head fake to the upside, a head fake to the downside, and you could try to execute both of those, in both directions, both setups, and you're going to get stopped out on both. So it's, again, very important that you know this method so well that you can identify when it's not going to work, and then have some strict rules and guidelines as to when you use and execute this trade. Again, the way it's set up right here was perfect. The way it's set up right here was perfect. This was even better right here, in my opinion, because it retested a definite level of resistance that we saw from the previous day. That was actually an even better setup, and you can see why it was also a better setup. We were in and out to the first target really quick. I would rather have my trades pay off and move a lot quicker than to have my trades sit there for 7, 8, 9, 10, 12 hours not going anywhere. Sometimes a little bit negative, sometimes a little bit positive, and then it's still going sideways inside a consolidation. That's exhausting. And the longer you have a trade open like that, the more susceptible it is to news, tweets, fake news, all kinds of stuff that can create sharp spikes in the opposite direction, like 50, 60, 70 pips, and then ultimately it'll come right back down where it was, and then it resumes its trend. Those are horrible to be stuck in, and you've probably been in those trades a lot. And you can identify when it's likely to happen in most cases if you learn how to read volume and if you learn how to read these turning points. So this is what I'm doing all day long with the trade copier. And this isn't the only strategy. This is just one, and it works really, really well. It's something that I do prepare for, and it's why I start my trading at the London Open. I am prepared. Obviously, I'm sitting at my desk before the London Open. I'm watching all the activity before. But I wait for very specific locations. I don't just jump in and out and chase price up and down. In the middle of an uptrend like this, I don't want to get in because you don't know how far it's going to reverse, and you got to honor the initial stop loss, and you just end up adding more to the stop loss. It can be a mess when you start chasing price just to get a little bit of movement or an opportunity to scalp some pips. You got to wait for the right entry and learn how to read these turning points in the market.